Energy stocks are currently trading at the lowest valuations of history. Despite the S&P 500's strong performance over the past year, energy stocks have barely budged, making up less than 4% of the S&P 500 by market cap. This is the second lowest level in the past few decades, including during the dot-com bubble. The energy sector is expected to grow its free cash flow by 5% to 20% per share this year, with some companies like Devon Energy and Diamondback Energy showing significant growth potential. Natural gas pipeline giant Kinder Morgan also expects to grow its free cash flow by 8% this year, giving it a free cash flow yield of 13%. These stocks are considered dirt cheap and could fuel phenomenal returns in the future, as they are undervalued compared to the S&P 500's forward PE ratio of 21 times earnings. The journey of a stock from being undervalued to achieving stellar returns is not just fascinating, it's a playbook for strategic investment. But how does history guide us in identifying these hidden treasures? And more importantly, which stocks today are screaming buys, ready to replicate the success stories of the past? Historically, the market has gone through cycles of peaks and troughs. During these fluctuations, certain stocks have been beaten down to prices that don't reflect their true value or potential. It's in these moments that savvy investors have swooped in, recognizing the disparity between price and intrinsic value. Now, let's dive into something super interesting I found. Did you ever notice how energy stocks are kind of like the unsung heroes of the stock market? Check this out. Right now, they make up less than 4% of the S&P 500. That's even less than during the crazy days of the dot-com bubble, making it one of the lowest slices of the pie we've seen in decades. But here's the twist. Energy stocks are actually bringing in 10% of the earnings for the S&P 500. So, logically, you'd think they'd have a bigger share of the market, right? Something like 10% to match their earnings punch. That would put them right back at their average historical importance. Get this, Rick Muncrief, the big boss over at Devon Energy, which is all about oil and gas, dropped some interesting insights during their last earnings call. He thinks the reason for this mismatch is pretty much down to the tech sector's sky-high valuations overshadowing everything else. Plus, there's a lot of folks who don't quite get how much we're still going to need hydrocarbons moving forward. It's a fascinating take, considering the role of energy in our lives and the market. So, here's the scoop from the past year that's been buzzing around. The tech world has been on a wild ride, with their stock prices shooting up over 50%. That's a huge chunk of what's been pushing the S&P 500 up. Meanwhile, energy stocks? They're just chilling, hardly making a dent. Now, with all the hype around artificial intelligence, tech companies are getting some serious love from investors. We're talking sky-high prices. To put numbers on it, the whole S&P 500 is trading at about 21 times what people think the companies will earn. But the tech-centric NASDAQ 100? That's hovering at a forward PE ratio of more than 30. Yeah, you heard that right. And if you think that's something, just rewind a year. The S&P 500's PE ratio was chilling around 18, and the NASDAQ 100? Less than 25. Talk about a growth spurt in multiples. It's like everything tech just went through a growth spurt on steroids. Alright, let's tackle another myth floating around about energy stocks. Some folks think demand for oil and gas is dropping, but that's just not the case. Rick Muncrief from Devon Energy threw some light on this. He mentioned, hey, the world isn't slowing down on energy needs. In fact, we're looking at a 50% jump in global energy demand by 2050. So the idea that we're hitting peak oil demand anytime soon? Nope, not happening. Our planet's thirst for energy is only getting stronger, and oil and natural gas are going to be major players in keeping up with this growth. So what's the deal with energy stocks getting the cold shoulder? Their prices should be gearing up for a climb, considering all this growth on the horizon, instead of the market acting like they're about to take a nosedive. But here's a thought-provoking question for you. Which sector do you think is currently the most overlooked by investors, yet holds the potential for exponential growth? While you are thinking, Don't forget to hit the like button if you're enjoying this deep dive into stock market secrets. Subscribe and turn on notifications to stay updated with our latest insights. Now, back to our quest for undervalued stocks. Drilling for value in the energy sector. So, if you're looking for a prime example of how the market's kinda missing the mark, let's talk about Devon Energy. This oil giant's got a couple of aces up its sleeve. They're nailing it with how efficiently they use their capital, and they're seeing the costs for their services go down. What's that spell out? A sweet increase in their free cash flow, projected to hit 20% this year. And that's with oil prices hanging around $80 per barrel, which is just a tad above where we're at now. Now, here's where it gets juicy. Devon Energy is rocking a free cash flow yield of 9% if we dial the oil price back to $75 per barrel. And that's playing it safe, considering where prices stand. Comparatively, that makes them look like a bargain next to the S&P 500's 4% yield and the Nasdaq's 3%. What's driving Devon to double down? Their game plan is all about buying back shares in 2024, seizing the opportunity to snap up their own stock while it's dirt cheap. It's like they're saying, "Discount? Yes, please." Well, where is another player in the oil and gas league, Diamondback Energy, or as the cool kids call it, FANG? These folks are also snagging the spotlight for how incredibly affordable their stocks are right now. Picture this. With oil at $70 a barrel, Diamondback's rolling in more than $15 of free cash flow per share. That's right, their free cash flow yield is cruising over 8%. If oil prices hit the $80 mark, Diamondback's not just playing the game, they're changing it, generating over $19 in free cash flow per share. This pumps their yield up over 10%. For a company that's not exactly in its garage startup phase, those are some pretty sweet numbers. And interestingly, Diamondback's eyeing a 5% boost in oil output per share this year alone. So if oil prices hang around the $80 ballpark, they're looking at a free cash flow jump of more than 15% per share. Talk about moving and shaking. All right, let's not forget about the big players in the pipeline game, like Kinder Morgan. They're not just another face in the energy crowd. This giant in the natural gas pipeline sector is gearing up to boost its free cash flow to $2.26 per share this year, marking an impressive 8% hike. And get this, they're flaunting an insane 13% free cash flow yield right now. But here's where it gets even cooler. Kinder Morgan is like that friend who always knows how to split their paycheck. They use half of their reliable cash flow to treat their shareholders with dividends, which, by the way, are currently yielding a sweet 6.5%. The rest? It's smartly funneled into making more money down the road. We're talking investments to pump up their cash flow, snagging their own shares while they're a bargain, and beefing up an already solid balance sheet. With eyes on the prize, Kinder Morgan is set to ride the wave of an expected 19% jump in natural gas demand by 2030. They're not just playing the long game, they're planning to win it. Imagine everyone's at the party flocking around the IT stocks, dazzled by their flashy tech and AI talks, leaving the energy sector's stocks chilling in the corner, unnoticed. This scene's made energy stocks look like hidden gems, seriously underrated. But here's where the plot twist comes in. Once the crowd starts feeling the tech stocks' roller coaster vibes and decides they've had enough, they're gonna start looking for something solid. That's when they'll spot the energy sector, standing there steady with oil and gas, promising some serious growth ahead. Just like that, energy stocks could start getting the attention they deserve, seeing their value shoot up as investors catch on to the potential party going on in the energy sector. And there you have it, folks. We've taken a whirlwind tour through the undervalued world of energy stocks, uncovering the potential gold mines waiting just beneath the surface. If you've enjoyed our deep dive into the energy market and want to stay ahead of the curve with more insights and tips, don't forget to hit that subscribe button and ring the bell. Share your thoughts, experiences, and questions in the comments below.